What's up investors, Sneers here. It's been a long time since my last video with the ASOS deep dive, and due to many requests I got both in the comments to the video and some in my Twitter DMs, I make this update about ASOS. As always, this update is in my newsletter in a written form. You can see it right now on the screen. The newsletter edition of it is much more detailed with all the data points you can explore, and in the end there is a dynamic DCF valuation method which you can play with. You can see you can change the numbers. We will get to that in this video in the end, but I do recommend you will subscribe to the newsletter. The link is in the description below if you like to read and if you want to explore the things that I say here with the links to more details in your free time. Let's begin with the price of ASOS since my deep dive. You can see here that the price dropped almost 60%. So what I want to explore in this video is why the price dropped so much. What are the reasons, what are the updates since my last deep dive, and whether these changes and these updates are affecting the thesis, and did I sell, did I bought more, what is the status here, what do I think about all these things, and we will go deep into them. But before we focus on ASOS, I want to look at the broader fashion market. So you can see right now on the screen some stats I covered about big fashion companies and their revenues. So if we begin with ASOS, we can see that in February 2020, before the pandemic, it was almost 2 billion. And in February 2022, it was 2.6 billion. So it was real growth, even if we take into account, and which I take here, 10% total inflation from 2020. It was more or less in other parts of the world, but that's what I used here. And then we can see that other companies, Inditex, the company that holds Zara, Pull & Bear, Bershka and other brands, February 2020 of 17 billion, 17.1 to 17.7, which is less than 10% growth, so it's a real shrink. Primark from 3.7 billion to 3.5, that's absolute shrink. H&M 5.7 billion to 5.1, absolute shrink. The Gap 4.6 billion to 4.5 billion, absolute shrink. Boohoo, a competitor for ASOS, is posting the first UK sales drop. The ASOS is not in that dire situation. We can see here they are still growing in the UK. We will get to that, but that's just an indicator that the entire market, the entire fashion market is currently going down, and there are many reasons for that, and the main culprit is of course inflation and the economic situation around the world. With inflation rising, people want to spend less on fashion, and I want to exaggerate the word fashion because ASOS, H&M, Zara, those are fashion companies, those are not clothing companies. If you have less money, you don't want to buy the most fashionable clothes for a premium, but you will go to Walmart and pick up some clothes. That's not the same thing. That's buying clothes versus buying a fashion. So as a market is non-essential, people prioritize it lower, so the entire market is going down. And I want to put it as a context for the next conversation. As you can see now on the screen, I have some quotes regarding the inflation and the effects from the last earnings calls by the new CEO, Jose. I'll leave it for you to read in the link below in the newsletter. But the main thing about the inflation environment and what it causes is that for the fashion market, as it's a non-essential product, it's in a lower priority for people that now see less available income to spend on things. Eventually that leads to the demand going down while the same competitors are on the market, the demand going down, all while the costs that the businesses have to spend on labor, on materials, on shipping, on all of these things are going up. So lower demand while costs are going up. That means that sales are going down, as you saw. But not only sales, because the costs are up, the margins are going down as well. So less profit for these companies. So the inflation is a double whammy on the fashion market. Not only the fashion market, many other markets suffer as well. That's why stocks in general are going down in an inflationary environment. But in this situation, that's what happens right now, and we have to recognize it. And that's part of the thesis. That's why I bought into ASOS. I bought it as a value play. Did I bought it too early? Maybe. But I didn't try to time the market. I tried to value the company in the very long term and then assess whether the price is right. Of course, it would be much better if I bought later when the price got cut by half again, but it is what it is. With that said, let's take a look at the June financials of ASOS, and let's look at the sales compared to 2021 to see what's going on, to get the picture here. So we can see that the UK is having a modest growth, which is amazing considering the inflation and the economic environment in the UK. And as I said before, Boo is seeing less sales in the UK. So it's a good situation compared to the market. In the EU, a bit lesser sale, which makes sense due to the inflation and due to the hardships by the Brexit. But an important thing here is that the US is seeing some nice growth, which means that the supply chain issues and the logistics issues with the US warehouse that I wrote about in the deep dive a few months back, it seems that most of them are now resolved, and the Nordstrom partnership is going very well, and it's reflected in the growth in the US market, which is great as this is the next big market for ASOS. The last thing is the rest of the world, which we see another downgrade here, which is understandable because the shipping costs were so high and it made a lot of the products and the business in the rest of the world not viable. The next thing is the margin. ASOS announced that the gross margin shaved 3.1% down to 44%, and margins were already low for ASOS compared to the entire market, as I showed in the original deep dive. So it's another hit to ASOS to have even lower margins, and they named the freight costs as the main culprit. Now that's the report from June, and since then you can see this is the freight costs, the average freight costs. So June was about here, and these are the reports of everything before it, and you can see that since then the prices are going way down. So at least in the point of freight costs, we have a silver lining. Next, I want to go back to the price chart of ASOS stock and look at the two drops. We can see first drop here and a second bounce drop here. And the first drop was in June when the new financials and new CEO, Jose, were announced. And the second in August was when the departure of the past CFO, COO, Matt Dunn, was announced. Let's start with the new CEO. And I want to start with a point not specific to him. I want to start with a point I made on Twitter that the market often acts insane when a new CEO is appointed. And you can see here, this is the chart of AMD from 2014 when Lisa Su were appointed as CEO. You can see the massive drop, almost having the stock within a quick few months since the announcement of her being the CEO. And what I want to talk about here is that the drop in the market doesn't necessarily say anything about the quality of the manager, as we saw in AMD case, but there are many other cases like that. The market often doesn't like new CEOs that won't do great things for the shareholders in the short term. And Lisa Su, and in this case Jose as well, they are CEOs who are practitioners of the profession. Lisa Su is an engineer first, manager second, and Jose as well is a designer, a fashion man first, and then a manager. And often a practitioner is a mid to long-term play because they focus on the product, they focus on the quality, they focus on the mission of the company. And being focused on the mission of the company usually means more capital expenditure, less attention to margins or things like that. And that leads to short to mid-term downturn in the stock. But if the practitioner is successful in his mission and he understands the market, he understands the product, if he's successful, then the growth in the long term is much, much better than can be with a CEO that doesn't understand the product. And on the other side, if the CEO is a salesman, an MBA style kind of guy, he knows how to focus on the things that shareholders like in the short term. They like more margins, they like more profits, more free cash flow, things like that. Think about the CEO of Boeing, which is an extreme case because he was a great salesman and he got the profit much higher very quickly, and we saw the Boeing stock price going high very quickly, but in the long term he didn't focus enough on the engineering, on the product itself, and it caused some issue. Another example is Intel, that for the past few years had salesmen and marketing guys as CEOs, and they extracted a lot of value from the existing products of Intel, but neglecting the core product engineering, which led in the long term to AMD getting over Intel's performance. In the case of Jose as a product guy, it's much more scarier for ASOS in the current times, in the short terms, because ASOS has to handle supply chain issues, inflation, and logistics, these kind of things, which are not fashion things. Those are things that a classic MBA guy knows how to handle. So having Jose as a product guy, as CEO, is understandable why the Wall Street guys got spooked and the price got dropped. The next thing I want to talk about is the COO CFO departure of Matt Dunn. In the original deep dive that I wrote, I said that he's an amazing guy and I trust him, and I even thought that he will be elected as CEO because of these qualities, because he comes from finance and he has a lot of experience within ASOS. He's been there for over 3 years, and him leaving is not a surprise because I'm sure a lot of other people also expected him to be CEO, and since Jose is a CEO, typically that's the kind of things that happened in these kind of companies. The one that also ran for CEO is leaving soon thereafter. And it explains another drop because he is the finance guy. He is the talent that can handle the supply chain, logistics, all these kind of things. And now that he's leaving, it's one less great talent within ASOS to handle these kind of things. So it's understandable why the drop related to his departure. So the question is, can ASOS manage those issues with a CEO that is more of a product guy, the fashion guy, and without the talented CFO that we had for years who knows ASOS? Can we manage to do it? And I think that we can. They will have some hurdles in the coming 1 year or 2 years, but they don't have a lot of debt. Their sales are stable. They have the money flowing in. They will manage, and I look for the very long term. I'll look for 10 years at least. And I think that it won't matter in the viewpoint of 10 years. They may have some issues in the short term, but I don't want to gamble on it or try to time it, like selling everything now and getting in when it will drop, because I don't know if it will drop more. Maybe the market already priced in the risk so much that they quote down way too much to face this risk. So maybe we already hit the bottom, and then if I will leave, I won't catch it going back up. So I don't like to time these kind of things. I think that they will manage it. They won't catch bankrupt. That's out of the question, but it will take some time. And I think we already see now indicators that things are easing for ASOS. We saw that the freight prices is getting much lower. We saw the US growth, which indicates that most of the logistics issue that ASOS had with the US warehouse are mostly resolved, and that explains the high growth in the US market. And I don't want to talk about inflation because nobody knows where this is going. And that's the thing, I don't want to gamble on it. And with that said, let's take everything I said and dump it into a new DCF model. So you can see now on the screen, I had a DCF valuation model in the original deep dive, and in this one, I adapted it. First thing that I adapted is the owner's cash flow that I calculate from. In the first one, I calculated from $150 million. This time I slammed it down all the way to $60 million. That's because I want to take into account more pull forward for 2021. Maybe they pull forward much more demand than I thought, and to allow to lower margins, which I don't know for how long it will continue. It can be 1 year and it can be 5 years. So just to adjust to that, let's use $60 million against $150 million. I know this is a very deep lowering, and that's kind of the point. I don't want to be too optimistic in this model. I want to get everything so much down that you will doubt that it's the reality. The next thing is the bear and likely and bull cases. You can see here there are 3 cases and the growth rate for them, and I lowered the growth rate for each significantly. So the bear case is 3% growth every year for the next 10 years, and the likely I put 10%, and in the bull case I put 15%. Now, just to give you a context, if you look at the growth of ASOS 2015 to 2022, it was 20.5%. And if you want to filter out the pandemic, because that's an online business and they earn a lot from it, so let's look at 2013 to 2020, that's again 20% every year. So even in the bull case, I didn't put 20%. And to think that we will have only 3% growth for the next 10 years, where right now it's the peak of the hurdles for them, as we can see that the freight costs are easing and the US growth is easing and everything like that. And right now they are at 3%. So to think that it will continue for 10 years, it's unlikely. But again, it's in the bear case, and I took extra measures to be extra cautious in this model. So that's that. And in the terminal measure, of course, I adapted the new owner's cash flow with the growth, and I kept the discount rate at 15% because I don't want to lower it. I always like to use it as a kind of margin of safety. So let's look at what the new model gives us. Of course, I also adapted the terminal multiples accordingly. We can see here the terminal values, the intrinsic value. The intrinsic value is of course calculated from the risk-free rate, but what we want to focus on is the purchase price, because that included the 15% discount rate that I included here, and it's somewhat included the margin of safety. So we can see $500 million for the bear case, $1 billion for the likely case, and $1.6 billion for the bull case. And taking all the probabilities that I assigned to each and combine them, we can see a purchase price of $900 million. Now, the current price of ASOS is $780 million. So the current price has a margin of safety on the 15% required return that I put in this model, which is already very much slammed down. So given this thing, I will not trim down my position, but I will also not add more, because my position is already large enough and it's a significant portion of my portfolio. So I will leave it as it is. But I think that right now the price is, of course, much better than it was when I initially did the deep dive. And if you still believe the qualitative analysis that I did in my original deep dive, by the way, go and see it if you haven't, of course. So the story is still here, and I will keep holding ASOS because I believe in them in the long term. And that's it. That's my valuation. And I hope it was useful for everyone watching, and I hope to see you next time. Bye bye.